We start today's market talk. Next week's rate cut comes with considerable analytical uncertainty about the end point for rates, the journey to that destination, the impact on the economy, and for international spillovers. Focus of Fed is now on minimizing labor market weakness than inflation. US bond yields have softened and dollar has weakened. Employment is seen as a lagging indicator of the economy, which raises the possibility that the economy has weakened already rapidly and soft landing may be difficult unless Fed cuts rates aggressively. What will be the impact? What will be the future trajectory? There is a lot of inputs which are still not available. So you can't really say that will be just a soft landing and everything would be good. Let's see how it manifests. Market outlook, as I see it, the rally in the US was pushed higher by US inflation coming in as expected, and it raised a probability of 50 basis point rate cut at the next FOMC meeting next Wednesday, which is now 50 basis point is now even. So markets are unsure about what to expect, seen from rise in CBOE VIX index. But the mood point is that whether it is 25 or 50 basis point now, over the next 2 years or so, the rate should be lower by at least 200 basis points from here. So that trajectory is known. US markets were impressed by Nvidia chief executive Jensen Huang's remarks that there was immense demand for his company's products, which ignited a major rally on the Wall Street. Now, his remarks have put to rest concerns over the hype over AI, that the AI was a unnecessary hype, etc. There is substance. Blackwell, their new chip, will make a market debut later in the year, and this firm will retain its position as the leader and favorite chip maker for all the AI related companies. The prospect for US rates have already led to return of lower US rates have already led to return of foreign portfolio investors to India, return of FPI inflows, in addition to huge amount of domestic liquidity sloshing around the system, which is seen by subscription to these IPOs, is always a positive sign. The realignment in global supply chains and geopolitical partnerships is opening new opportunities. India is embarked on a mammoth task of capturing them with a good start. Success of Apple's iPhone manufacturing in India is a case in point. Vote of confidence from Apple can help change India's image as the world scramble to reorder its supply chains, reconfigure their supply chains. Opportunities are in EMS, chemicals, and pharma sector. The US Biosecure Act is yet another opportunity for Indian firms. The sharp fall in crude prices, perhaps on worries about lower oil demand in a global slowdown, will also help. So this US Biosecure Act is likely to benefit contract development and manufacturing organizations, contract research organizations in India. In India, companies involved in discovery or development of molecules are likely to benefit from possible shift of US companies to new vendors. First order impact will be on companies like Syngene, Laurus, Viramil Pharma, DBs, etc. Large generic players like Sun Pharma will also benefit. Then companies working with these innovators or intermediates who make APIs like Ami Organics, Concord Biotech, Naveen Fluorine will also benefit from the second order effect. RBI has given no indication of cutting policy rates. So despite its encouraging data on food disinflation and August retail inflation data, which came at around 3.65, RBI is still not changing its stance, etc. But people are expecting RBI to start cutting rates as early as next month. Now coming to US, this week in the US markets, the narrative reversed from concerns over economic growth to expectations of a Fed cut on 18th based on inflation data, where the headline CPI was in line, but core inflation was slightly higher. So if you see the technical chart of US 10-year yield on the weekly charts, it was since 2022 on a upward trajectory, making higher highs and higher lows. It was only in March 24 where the trend has changed, and now it is heading lower. It is now making lower highs and lower lows, and it is likely to trend lower. It is already below the 100 EMA and may test this 200 EMA level of 3.32 uh, once the future directions of rate cuts are clear. Uh, US dollar index is also correcting. It has tested this support of around 100 odd levels for dollar 3-4 times, and one odd day it will breach, but it is in a downward trajectory. So it is also making lower highs and lower lows, and it is expected to trend lower. It has already broken that 200 EMA. So now it is in a dollar is in a bear market. Dollar yen trade, which caused a problem in August after the steep fall to 140, it rose up after the positive comment from the Japanese banks, Japanese central bank, but it has now come back down again to 140 level uh, because of there is a uh, rate cut or a rate related meeting in Japan also next week, and the result will be out on Friday. So, but what has happened is first time it surprised the market, so the market's corrected. But now, market is well aware, and yen carry trade is basically a margin call only, where people borrow at nearly zero rates in Japan and invest in other parts of the world and basically in tech stocks in the US, etc. So that rally had halted initially, but now people have squared off their positions or whatever it is. So it is not going to impact the markets that to that level. Brent crude is again going down based on weak global demand expectations. It has come to the level of around 70 odd level, where this level of support it had tested last 2-3 times. So let's see from where it goes. Uh, Most likely there would, and it is all below the 200 EMA. So most likely there would be a bounce, and then it will test that level again or break that level. So let's see where it goes. Gold is in an upward trajectory. It has broken that 2600 level this week and is over a period of time is expected to go to around 3000 levels. Copper was kind of consolidating. It is consolidating around its 100 EMA. So there is no bull market in copper. There is adequate supply. So, and with the expectations of lower economic growth, this is not going back to that higher level again in a very quick time frame. There is a big gap here which has to be still filled. Nasdaq bounced back from the big red candle it made. It bounced 5.93% last week, which was a good point, and it went above the 200 EMA on the weekly chart. So it may test this upward trending trend line again. And miraculously, a good point is that it didn't make a lower low. So it is still in a bull market, may test this rising trend line and then may keep going higher. Nvidia, similarly, it had corrected last week. Last 2 weeks, it was been correcting from the highs, but now it is coming back again. And if it breaks this 130 level, it may make a fresh high. India VIX has been declining and has come down to 12.5 odd levels. So it is expected to go down further as this uncertainty is of the US rate cut is removed from the system. Indian government bond yields, I've been talking about it. They are trending down lower. There is a clear lower tops, lower bottom formation, and it is heading to now that 6.7 level. Once it has broken the 6.8 levels, so it will fall further as the US yields will fall. This is in expectations of rate cuts in India also. Now coming to Nifty. Nifty made a lifetime high. It is outperforming other indices. It made a bullish engulfing pattern and made a megaphone pattern. The range is expanding, so there's higher volatility. So volatility is expected to go up, but it is expected to go further up. So if you see last week, last week, it made a bearish engulfing candle, and this week it made a bullish engulfing candle. So with higher amplitude. So it is only signaling higher volatility. On a daily charts, it bounced from the 20 EMA after taking support at these levels. So now this 20 EMA has moved to 25,000 level. So that level should provide a decent support. Till the time it is above the 20 EMA, it will keep it will remain in the bull market. On the hourly charts, so if you see here, it was consolidating for the whole week until on Thursday at 2 o'clock, it got a spike. It moved up from around that 25,000 odd levels to 25,500 levels in a very short time frame. And now it is again consolidating at these levels. So let's see which direction it goes. Nifty Bank closed above the 20 EMA. Short-term outlook is positive. On weekly chart, it made a bullish engulfing pattern after a bearish engulfing pattern, which indicates change in sentiment. In coming weeks, it likely to go higher. The last high was around 53,000 plus. So first it will test that. It already tested the 52,000 levels. Should break that next week and go higher. On the daily charts, it is above 20 EMA and it is trending upward. So this trend is looking positive for it. And even on the hourly charts, after the spike on Thursday, though the Nifty consolidated on Friday, but this was still going up on Nifty Bank. So Nifty Bank is looking stronger right now. HDFC Bank is been in a consolidation for last 2-3 months in this range. It will go and test now this gap which it had made around that 1680 levels, and it has to cross this gap up to 1720 for a further upside. So otherwise it will test that, reverse from there and test the moving averages, nearest moving average. Reliance, it's below the 100 EMA, so it is looking weak. It tried to cross that, but reversed from there. So this will continue to be weak. I think the next trigger would be the announcement of the firm date for bonus, and in case there is a cut in the windfall tax. Now, the stock which was in momentum last week was Suzlon. It had made a high at around 80, and then it was declining, and then it took support at 20 EMA, and then based on the news of it getting a big contract, it has bounced back up. So it is now with momentum, and RSI has reached around 67 level. It's expected to go up higher. Then let's see after what happens with the results in the next quarter. The weakest index is PSU Bank Index. It is at the same level it was in February. It bounced back a bit last week. On the weekly chart, it bounced back from the 50 EMA. So let's see if we can break these resistances or may go down further. Right now, the sentiment is weak for the PSU Bank, but it had run up a lot. Midcap index continues to move higher. It made a strong green candle. Similarly for small cap index also. So the broader market are doing well. Now I'll cover three stocks. First is Paramount Communication. It's a prominent player in India's wire and cable industry with a diverse portfolio of over 25 products and 2,500 SKUs catering to the power, telecom, railways, and infrastructure sectors. Its pan-India distribution network has been pivotal to its growth, reaching over 600 institutional clients, 150 channel partners, and 7,000 electricians. It has a wide presence in both domestic and export markets, with a solid foothold in the US, Company has made significant strides in reducing its asset reconstruction company ARC debts and aims to be debt-free by FY25. It delivered a revenue EBITDA CAGR of 15.3, 18, and 34% over FY 2024. Notably, the export segment displayed robust performance with a revenue CAGR of 80%. Management expects revenue to reach 1,350 crores by FY25 from around 1,000 crore right now and rupees 1,700 crore by FY26. So that is CAGR of 20% over the next 5 years, with 10% EBITDA margins driven by its B2C market in the US contributing to 40% of the total revenue. Export revenue is expected to reach 450 crore by FY26. Company has an outstanding debt of 190 crore owed to an ARC asset reconstruction company in FY17 payable over 8 years. The final repayment installment is scheduled for November 24 and the company is considering prepaying rupees 98.3 crore of the balance amount in this tranche. Scale up of business post repayment of ARC obligation should take place. Domestic cable business of theirs is driven by power and railways. It primarily exports power cables, accounting for 50% of India's total exports to US in this category. Total equity infused by promoters since calendar year 10 is rupees 128 crore. Its current outstanding debt is only from an ARC, which is non-interest bearing and being repaid on schedule. The company's working capital days are high at 137 days compared to KEI 83 days, RR Kabul 61 days, and Polycab 36 days due to increased inventory and debtors as export business was impacted in current FY24 and increase in domestic government business from 5% to FY23 to 19%. So basically, the problem is the debt to ARC, which it had to repay so that it can start utilizing the banking facilities. And the second problem is the cash flows problem, which I'll show you because of large amount of inventory and receivable days are very high. Now coming to their quarterly results, they grew roughly 50% year on year in terms of sales. Operating margins have also improved and they have now stable at around 8% and they are saying they will improve. And the profit after tax and net profit also nearly went up 60 to 70%. So which is positive. So they did around 1,070 crores of sales in FY24 with the EPS of around 3.8 rupees. And as they are saying that they are likely to do around 1,700 crores sales in FY26, so they should do a EPS of around 6 or 7, considering the capex and other requirements. So at 20 times P, 20p, they can easily trade at around 120 to 140 rupees. If you see here, their ARC debt repayment schedule, they had bought a cables and wires companies in UK. Now this company folded up in 2008 global financial crisis and they had a lot of debt. And then they declared they were not able to clear that debt or they defaulted. So the banks sold the debt to ARC and then the debt got transferred to ARC for 190 crore. And now this debt they have been trying to pay from FY20 onwards and they are supposed to pay by November. The balance of this 190 crore now is around 98 crore, which they are expected to pay as early as possible. They have good relationship with distributors in US and they should get helped by higher duties on Chinese wires and cable companies. Post payment of ARC debt, company will have access to banking channels for working capital support, lower margin money required for bank guarantee for various government contracts, and supportive trade finance for distributors and dealers, which would help them to scale up domestic B2C segment also. The basic problem, as I brought you, is only of receivables and inventories, which they have to sort out. Uh, their domestic revenues have increased, which is very positive. They have nearly reached 800 crores now. So it's a steady rise now. And after earlier it was declining, so now it is rising. The main constituents are power cables and railways, while telecom, optical fiber, domestic wires, EPC projects and pipes are other part of the business. But 75% is power cables and railway. Uh, right now, the export revenue is 26% and domestic revenue is 76%. Domestic revenue growth drivers are power consumption rise, growth of renewable energy, growth in railway, metro, and highway networks, emerging industries and their ecosystems being set up by PLI, and projects to enhance inter-regional grid connectivity. Uh, export revenues declined in FY24 uh, from roughly 400 crores to roughly around 260 to 70 crores. So they are saying that they will make it to around 40% of their total revenues by FY28, next 2-3 years. Let's see, it has come down to around 26% now from 50% it was earlier. The problem is promoter pledging. They have around 26.52% of the promoter holding is pledged. And in a falling market, high promoter pledge shares put additional downward pressure on the stock. Their problem is cash flow. So they have a negative cash flow of around 100 crore in FY24, basically due to higher amount of receivables and inventory as I brought out. So this, they need to reduce their receivable days. Now seeing their chart, it made a high of around 150 knot in January. And then from there it corrected. This was a time when promoter had infused equity, tested the 50 EMA, then it was consolidated and moving sideways around that, and now it has got broken out above the 20 EMA. So every with higher volumes. Now in the last 3-4 weeks, it is trading with higher volumes. So which is a positive sign. This should show there's interest in the stock. So every dip closer to 80 should be a decent buying opportunity. Next stock I'll cover today is Global Health. The group's flagship Medanta, the Medicity Hospital, is in Gurugram. Other super specialty hospitals are in Lucknow, Patna, Ranchi, and Indore. So basically, right now it has 5 functioning super specialty hospitals in all the major cities in north and central regions of India. Medanta has 3,440 bed capacity as of Q1 FY25. It is ramping up its capacity in all these regions, especially in Lucknow, Patna, and Noida, with plans to add 500 beds by end of FY25. Target to achieve 5,000 plus bed capacity over the long term. It is pursuing an ambitious capex strategy and expanding into other regions such as Mumbai or Shivara. Expect it to achieve an 11% sales CAGR and an EBITDA margin expansion of 120 basis points to 26.5% over next 2 years. Developing hospitals are expected to clock an 18% CAGR over FY24 to 26 with a margin expansion of 330 basis points over this period. It plans to add 50 beds in Gurugram and Lucknow each, 150 beds in Patna and 300 beds in Noida by end of FY25. It is implementing efforts to onboard clinical resources at Noida. It would spend 1,200 crore, inclusive of land and FSI purchase, over the next 3 years to build a 500-bed hospital in Mumbai. It is looking for regulatory approval to start construction of South Delhi project. Seeing their income statement, they've had good rise in their revenues. So 20% rise over FY23. So it has reached around 3,275 and expected to reach around 4,000 crore in FY26. Margins are likely to remain stable to around 25-26%. And profit after tax improved around 46% year on year in FY24 and expected to improve at CAGR of 10-15% over the next 2-3 years as they are doing a lot of capex. EPS is been rising at a decent pace, and it's expected to be around 25 or so in FY26. So ROE, ROC are improving. The P at for FY26 wise, it will be presently around 45, but it can easily trade at around 60 P. But at 60 P, it comes to approximately 1500 odd level. That should be the decent level or a target for this stock. All its working capital leverage ratios are improving, so that is not a problem. Its sales are improving, both mature hospitals and developing hospitals, and are expected to go up to around 5,000 crores. Then overall CAGR of 11% over the next 2 years is expected in revenue. Year-on-year growth is also shown here. Sorry, to 4,000 crore. It is expected to go in FY26, not 5,000 crore. Expect 120 basis point margin expansion over FY24, FY26. So the margins are improving. So they will get higher average revenue per occupied bed. EPS CAGR is expected of around 17-18%. So expected to reach an EPS of around 25 in FY26. ROE, ROC are improving. Investment is going up. So they are likely to do around 600 odd crores of approximate capex over the next 2 years so as to increase capacity. Now let's see the chart. It made a high, and then after that in February, March, and after that it has been declining and taking support at this 1050 odd level. So right now it is somewhere trading closer to its 200 EMA. So this should be a good level to enter this stock at around 1100 rupees, and then next major support at around 1050 or between 1050 and 1000 level in case it takes support here. If it breaks here, then it will head lower, but unlikely to do that. The last stock today is Data Patterns. It's a private defense company. Out of 6.2 lakh crore defense budget, rupees 1.7 lakh crore, 27.7% is earmarked for capital acquisition, within which rupees 1 lakh crore is meant for domestic procurement and enhancing self-reliance. Defense capital outlay is expected to clock 8% CAGR over FY25-29, with capex likely to reach 31% of total budget by FY29. Surge in the share of domestic procurement to 75% in FY24 from 54% in FY19. Looking ahead, this trend is set to intensify further. So all these private defense companies are expected to do well, even if the defense budget and the outlay goes up to around 8-10%. The share of domestic procurement since it is likely to go up, they will have better CAGR growth, higher, much higher than the growth in defense budget. This company has exceptional R&D capabilities, own IPs, premium products, and robust export opportunities. Company's portfolio is well diversified with production, development, and service orders accounting for 45%, 51%, and 4% of its total orders. Currently, it has greater than 100 export orders and expects order inflows for radars from South Korea and Europe in the coming quarters. The company expects cumulative order inflow to the tune of 1,000 crore in FY25, which is higher than their yearly revenue. It used the QIP proceeds of 500 crore for developing fire control radars, electronic warfare systems, and communication suites. Over the next 2 years, the company will incur 150 crore capex for product development and contract specific requirements, etc. It's confident of getting direct orders from Ministry of Defense in the next 5 years, so that will increase their order inflow. Defense exports are expected to be around 50,000 crore in the next 5 years. So there is a huge opportunity. So they are going to become 2.5x in the next 5 years. Management expects to achieve 20 to 25% revenue growth in FY25, while its aim is to achieve 25% revenue CAGR over the next 2 to 3 years. While margin is seen at around 35%, it expects earning to grow by 25 to 30%. It will continue to fulfill orders from BL, and it aims to secure contracts directly from the MOD through competitive bidding. Additionally, the company is exploring export opportunities in UK and Europe. Now let's see their income and expenditure statement. So they are expected to do around 830 crore revenue in FY26, which is much lower than their present order book. EBITDA margin is improving. Profit after tax is expected to be around 275 crore. PAT margins are also roughly 33%. EPS is expected to be around 50-51 odd in FY26, and ROE is improving, so which will add to profitability. So if you see here, the EPS is improving by around 25% year on year, which is very strong. Now, let's see their product profile. Various test system, RF and microwave, electronic warfare, cockpit and rugged display, radar and radar subsystem, identify friend and foe, avionics, laser and electro-optic systems, space systems, power supply, naval systems, communication products, launch and fire control system, high-speed processors. So they are into niche products, niche fields, so which will have higher margins and a lot of barrier to entry because of good technology and IPs they have. Seeing their charts, it had risen up, made higher highs and higher lows, and made a high after the election results to around 3600. But subsequently, as all the defense stocks are correcting, this is also correcting and has now come closer to its 200 EMA. So this should be a decent level to accumulate. Otherwise, this low which it had made on the budget on the election day of 2400 should be a good level to accumulate this stock for long term. So RSI is somewhere coming closer to getting in an oversold zone. So it should see some bounce. Let's see if it finds resistance at higher levels. I have finished. Now we'll take questions.